Good morning, everyone. We have the pleasure of having with us Johannes Huth from KKR. Johannes, he has been a good friend of the firm and have had also the pleasure to talk to him, I think, last year. He joined KKR in 1999, and he's a partner of KKR and chairman of KKR Europe and the Middle East and Africa. So, Johannes, thank you for joining us again to our webinar today.
Yeah, hi Naji, good morning. I'm joining you from Paris today. It's a pleasure to be talking to you again and look forward to our discussion.
Great. So let's start with the market environment in private equity. I think we're going to be touching on private equity, but also financing for private equity. I would love to hear your thoughts as we speak today on May 9th as to the environment that we have seen so far folding this year.
Yeah, maybe I sort of go back to last summer, because I think that's when the market changed. And, we had a pretty good first half last year. Market was quite active. But really what happened is that this rapid rise in interest rates led to a rethinking of this market. And basically what's going on is the following. We're seeing much higher rates, banks that are a little bit more conservative, which results effectively in debt that we can get to finance our buyout being more expensive and actually probably being less available. So that means if we want to generate the same returns, we have to pay lower prices. There's no rocket science. It's a relatively simple equation. And what has then happened is that the vendors, sellers of businesses, have looked at what they got in the first half of 2022, and they're saying, well, why should I sell at a lower price? Not much has changed. And basically, that's resulted in a significant drop in activity overall. So if you look at the number of transactions that were done in the second half of 22, that was a significant drop. And we've seen exactly the same scenario continued into the first quarter of 2023. And so basically, we've seen a reduction in activity. And I think that's going to stay with us until people have adjusted to this new rate environment. And it just takes a little bit longer. We've probably seen the fastest rise in rates that we've seen in the last 50 years. And the adjustment to this just doesn't happen overnight. And so we're starting to see some early activities, but I would expect that activity is going to start picking up more, probably sort of towards the tail end of this year. So that's really, I think, describes the market.
And when you look at your approach to this as KKR, are you sitting on the side? Are you supporting your existing businesses versus buying new businesses? How are you reflecting on this? And what has been your activity in the private equity portfolio?
No, very good question. So with regard to the portfolio, which I hadn't addressed, and I should have, it's a very good point. Our portfolio actually continues to perform reasonably well. So we have seen our companies being able to pass through price increases. So we actually haven't really seen a significant compression of gross margin. And we've seen revenue growth continuing at some, really, if I look across the entire private equity portfolio and look at the average at sort of low double-digit growth rates. So that's, quite good, primarily driven by price increases. But still not bad results. Now, of course, like everybody, there's always one or two companies where not everything goes well, but I think that has not that much to do with the macro environment. So from a portfolio perspective, it's actually been quite good. Clearly, what we've been doing with our capital markets team is to make sure that our rates are hedged, that we don't have significant exposure to rising rates in the portfolio. And we've worked with our companies to be well prepared to sustain this higher rate environment. But from a new deal perspective, it's not that we're sitting by the sidelines. It's that we're trying to do deals, but we're pricing these deals probably differently than we would have priced them 18 months ago. And so very often the vendors don't want to sell. They stop sale processes. And I think eventually we'll be able to buy, make some investments. But for the time being, there's still a little bit of a gap between seller expectations and buyers' ability to pay.
What we have seen, and that always happen, as we know, Johannes, is the discrepancy in valuations between public and private. So definitely when we look at the public side, it has corrected. Private, we're still seeing the valuations not yet all adjusted downward. Do you see yourself looking at the public market as a potential source of deal flow and take private as a strategy versus what has been, prior to this, which was more private to private?
Yeah. So, I mean, let me address the valuation point first, because it is a fair point. But look, I think just by definition, the way we do our valuation, and we being KKR, but really broadly all the industry, is that we look at a set of comparable companies and see where they're trading. So we have the public markets reflected there, but that accounts for 50% of the valuation. The other 50% is we look at the projected cash flows of the business and we look at a DCF. And then we take those two, and the combination of the two actually give us the actual valuation. Now, the DCF will come down a little bit with higher rates because the weighted average cost of capital will come up, sorry, and therefore there'll be a small reduction, but not at all as large as what we've seen in the public markets. And therefore, if you look at a combination, we see a lower rise, but also a lower fall. It's just a more muted cycle in valuations. So that's what we're seeing reflected in the valuations. And I think that's I don't think that's an unusual time that we see this. I think that's going to continue.
And with regards to take privates as potential sources of deals.
No, absolutely. So let me come to that. So on terms of take privates, yes, I think that's interesting. You have to say, though, that in a number of the European markets, take privates have become more difficult. So the ability of doing due diligence before has been significantly reduced, especially in the UK market. The number of people that you can talk to is quite narrow. So it's become more challenging to do public to privates. But it's fair to say we've spent more time looking at some of the public situations because we do think there are some interesting opportunities there. So that's definitely an opportunity set that's there and that we're spending time on.
Okay. And when we look at the financing for transactions and the high interest rate, do you see yourself putting more equity in deals? And let's say what would have been maybe a traditional 50-50 before between equity and debt. Today, are you seeing yourself increasing the equity and then potentially applying a refinancing strategy once markets stabilize on the debt side? How are you reflecting on this?
Yeah, Naji, that's exactly what we've been doing. So I look at a transaction that we did in the end of last year. It was a French insurance broker called April. And when we bought it, the banks were at some conditions that were not attractive. So we actually bought the company with 100% of equity. And once we signed the deal, we then refinanced the debt part, and we refinanced that entirely in the private debt market. So with private debt funds. We don't have a bank in the syndicate. And we're seeing that more and more. And the private debt market is actually being quite active. And I actually think it's a very attractive sector right now in terms of where to put capital. And you cannot do huge transactions, but I would say you can probably raise in Europe somewhere between 3 and 4 billion of debt in the private debt market alone. So you can do some pretty big deals without the banks. And that's definitely a shift that we're seeing, that the financing is coming increasingly from private debt funds instead of the banks, which used to be the case for many, many years.
Which was saying that the private debt transactions almost this year are equivalent to the syndicated loan market, which also tells us how institutional this asset class became. And I think it's the first test really for the private debt to be a solution provider, because before they were competing with the banks, but now I think there's a window in which they are truly a solution provider to private equity sponsors. And I think investors who are gonna allocate to this strategy are seeing it as a real solution capital versus just another premium on top of what banks are lending. Would you agree?
Yes, 100%. And you know, to some degree, the banks are handing this marketplace to the private debt providers right now because they're quite nervous. They have significant, you know, some of them are still sitting on some unsyndicated loans. And so the banks have not stepped in, versus the private debt providers are becoming full solution providers. And also just the size, you know, before private debt market was really not able to fund very large transactions, but now they are. And you know, we're part of it with our private debt business. So I do think that's a shift that we're seeing, and I think that will be a permanent shift. I don't think that's going to go away. So I think the private debt market will be a continuing part of the financing scenario for private equity transactions.
So one theme that we have co-invested with you is the carve-out. We call it carve-out theme. So I'm thinking of Flora, I'm thinking of Wella, where businesses and market environments that we are living today start looking at their core expertise and maybe sell non-core. And what I liked about personally, what I like about those carve-out is the ability to generate returns from, you know, really enhancing the margin, and mainly from the cost basis, as you can deliver a lot of optimization on this side. Do you see businesses today going to that mindset of, you know, let's recenter ourselves to our core expertise and sell non-core? And are you eyeing some of them in the market environment? How are you reflecting on this?
Yeah, I mean, this has been for us a very big theme in terms of what we've been doing. You know, we've been doing it for a very long time. You know, starting with carve-outs from Siemens in 1999. So it continues to be there. I think it's for the reasons that you mentioned. It's been a very attractive place for us to put capital. You know, the most recent one, we invested in FGS, which was effectively a sale by WPP, which is focusing more on its core business, exactly the reasons that you mentioned. So the answer is, absolutely. I think it's a continuing, very interesting theme. It's something that we are doing. It's something that we've been specialized in, and we continue to find opportunities there. I think it's less of a. I think there always is something like this. You know, we almost every year we find one of these. And so I see this less as a big cycle. So suddenly there's a lot of carve-outs, and before there were no carve-outs. It's more that in Europe we've seen a continuous stream of these, not that many, but a continuous stream of these potential sales of divisions or carve-outs of big corporates. And yes, we're spending a lot of time looking at more of those.
Okay. Talking about themes that you like in this environment, I mean, the change of the interest rate and inflation and wages, maybe not sure how you guys have taken a step into saying we de-emphasize certain sectors from last year, and we're, you know, maybe overweighting or emphasizing other sectors. Is there any view that you're taking on different sectors that you can share with us?
So look, I mean, we've been very strongly focusing on 3 sectors, and I don't think that's changed because those themes are really more fundamentally secular driven. So ESG is a core theme for us in Europe, and that's not going away. Despite some of the noise, we think that's going to be a continuing theme that we're going to try to invest behind in various forms. We have you know, continued to invest in healthcare. And again, in Europe, aging population, it's a theme that we're going to continue to pursue. And you know, despite high or low interest rates, it's not going to go away. And then finally, we very strongly invested in digitization and software. And again, I think this is not a trend that's going away. So those fundamental themes, I think we want to continue to pursue in various forms. And you know, where we're looking at, are we still going to pay very huge multiples for fast-growing companies? No, we're probably going to be a little bit more choosy. Are we going to look more at value? Absolutely, we're going to look more at value. So I think there are some shifts, but the fundamental themes definitely remain.
How do you apply ESG? Just give us an example of an ESG theme.
So look, we invested in ERM. It's a world's largest consulting firm that basically specializes on environmental consulting. So looking for large companies at soil sampling, at what would be the or doing projects when they're building a new plant, what would be the environment, and advising on that. So we think this business is going to grow simply because the underlying demand for those type of services will be higher. It's a good example. We did this deal about 18 months ago. It's off to a good start. So that would be a great example of.
And do you have a dedicated team within KKR that touches on these topics with the portfolio companies?
So, I mean, if I take a step back for KKR overall, we actually have probably a number of different ways. We have in our infrastructure business a number of investments in renewable energies. So they've invested in wind energy, they've invested in water, they've invested in solar. And then lastly, within our latest European fund, which again from European nomenclature is an Article 8 fund, we're looking at themes that are relevant for larger businesses where we are investing behind it. And so within our capstone team, we have people that are specialized in this, and that will look at every company that we have and help those companies improve their approach to that. And then we clearly have a central team that looks at that also with a KKR head on, and then in each of the areas we have one. Lastly, we're going to be going out and looking at doing something that's much more focused on climate, and there, the amount of capital that you need to undertake some of these projects are quite large, but they're probably earlier stage than what an infrastructure fund would do.
Tell us about the consumer and how what's your view on the consumer sector, and if you have companies that are tied to the consumer, how are they how are they behaving today?
So look, I mean, we have Flora, as you mentioned, is tied to the consumer now. It's more, if you want, it's more to the basic good. That's done quite well. And performed very well. And I'm talking about Europe right now. This is a global business, of course. So my focus here would be Europe. Vela, again, another business you mentioned, which is basically providing products to hair salons. Again, in Europe, it's held up quite well. The US is a bit slower, but Europe has been reasonably strong. So I actually think the European consumer has held up reasonably well. And we've seen the results that some of the luxury goods companies have announced, which shows that certainly on the upper end of the market, consumption continues to be strong. So we have not seen a significant pullback given the sectors we're in from the consumer in Europe.
Okay, so despite the inflationary pressures, I'm assuming the companies are being able to pass through these to the consumer, and the consumer, because of the wage growth, are able to still maintain their consumption. Is that a fair way to say it?
That's basically what we've seen. Now, again, I emphasize that for some of these products, we're more on the economy end of the market, right? And so margarine is cheaper than butter, and so people may have switched, and we may have benefited from that. But so in our businesses, it's exactly as you said.
Okay. So let's speak about exits. In exits, I saw a report that showed the last 6 years exit. If you were to look at what has contributed to the exit between multiple expansion, revenue growth, or margin or earnings. So what has been defined is like 60% of the value that was created from exit have been attributed to multiple expansion over the last 6 years, 7 years. So that's and ending in 2021, of course. So meaning that, fundamental driving the revenue or earnings of businesses from enhancing operation has been the least part of the value creation. Of course, when anyone wants to invest in private equity, we can underwrite, let's say, the revenue, we can underwrite the margins, and then the multiple expansion or contraction will just be what the market defines it at the time of exit. How focused are you on this? And are you underwriting today multiple compression when you are buying something at the times of exit? You say, we're not going to assume any multiple expansion. Are you focusing much more on enhancing operations versus revenue growth, given the market environment you are in? Just walk us through a bit how you think about your underwriting from these three characteristics.
Yeah, so I mean, absolutely true, and we are, and we have been really since 21, not been assuming multiple expansion anymore, and we've been focusing on the fact that multiples will either be stable or, depending on the case, may even compress. And I think there's been a statistic which was published last week in the FT on secondaries, and that there's been a significant drop in secondaries, right, in sales between private equity firms. So that those have gone down a lot. And again, I think the reason here is very much that the same one that I started with, that we wouldn't want to sell the business at a much lower price, and the buyers were expecting a higher price. So it needs some time until we find a clearing mechanism, and the IPO markets have effectively been shut. Maybe just opening, but certainly have been shut for the last 9 months. And so I think it's that combination which has resulted in a real slowdown in monetizations and exits, which again, I think it's part of the cycle. Both deployment and monetizations have been slower. So what does this mean? It means it doesn't necessarily mean that we would not buy businesses where we see revenue growth. I still think and in some of the sectors that we're in, revenue growth can still be quite significant, and that makes a big part of the investment thesis. But it is really down to revenue growth and margin improvement, and we cannot bet on the market to create any return, and that's what we're assuming in our models.
Yeah, and typically in the exit world, you have, like you mentioned, selling to other sponsors, which are, bid and ask spread is still wide. It's selling also to corporates, which I would like to hear your view on corporates' position in acquiring businesses that you might own, and also, exiting through IPO, which we know is challenging. So. And maybe there's a fourth one, similar to the private debt. We're seeing the rise of secondary and GP continuation, i.e. you like a business, you don't want to sell it. Your LP wants you to get out of it because they've been in it for long. And then there's a solution out there that is coming, which is, allowing the sponsors to stay invested and replacing the LPs with new LPs. So maybe we can touch on two things. One, the corporates, and how are you seeing their activity in buying businesses that are owned by your community of private equity sponsor, and the second one, your view on the secondary equity, that is a new theme also that's coming.
So on the corporates, I think the corporates are actually in a reasonably strong position. Most corporates have a lot of cash. It's been a good market for them, and a number of corporates are looking to expand through M&A. And so we've seen the corporate as a potential buyer definitely come back. I would say it's still early days, but that's a market that I would expect to continue to grow. Now on continuation funds, I think there was definitely in the beginning of 22 a sort of, I don't want to call it hype, but for sure there were a lot of those things being looked at. I think that's slowed down a bit, but in terms of us and some of our competitors looking at maybe one or two assets where you say, look, this is a very good long-term asset, I'd like to keep it longer. I think this will be a valid and viable alternative to continue to own an asset and offer the option to our investors to either exit or stay in the asset. So I think it's here to stay, but it's probably not as active as we may have seen 12 months ago when it was sort of everybody was talking about it. So I think that hype has gone a little bit, and we will see it, but we won't see it in that volume that we saw before.
Okay. So if we were to look at it from a portfolio context at private equity allocation, I think the last years have allowed investors, as we mentioned, to be benefiting from the low interest rate environment, which pushed up prices, which contributed to the multiple expansion on exit. Also, they benefited from a openness of the market. Liquidity was available, so average duration was not too long to exit. People like yourself took advantage a lot in 21 to exit through IPO. So that was also there. So if I look at the environment today, and love to hear your view, but definitely valuation is coming down, so that's a good sign. But today you have an IPO market that is challenging, and you have businesses that you need to underwrite without multiple expansion. So really the revenue growth, earning growth. So would you say to investors, this is no different from going back to basics of private equity and the fundamental reason you should invest in private equity? Or you're saying, okay, no, that's another year or two of difficult potential market environment, but these could be a good vintage years for the future. How do you think about it from the private equity allocation?
I think these are going to be some very interesting vintage years, because for exactly the reasons that we said. Because pricing is going to be a little bit lower, leverage is going to be a little bit lower, multiple assumptions have to be more reasonable. So all of that's actually good if you buy a business, right? You don't want to buy when multiples are high and everybody is hyped and so on. And I think clearly, we had a period. I would say, I mean, as you said it, I would say the period that we've lived through call it maybe from after COVID, was unusual because we had very fast growth. Funds were able to buy and sell within 2 years. I mean, that's not the traditional private equity model, right? We went in there and we want to hold the asset, improve the asset, and that takes 5 years, and then we sell it with a good gain. And I think we're back to that world where we had a short period, which I think it's not that this world is unusual, it's that short period was somewhat unusual. But I do think this year and next year are probably going to be very good vintage years. And to some degree, the investors in private equity behave quite pro-cyclical. So at this point, people are quite reticent to put capital into private equity for many reasons, with denominator effect and so on. But I actually think these vintages of 23, 24 will turn out to be good vintages.
And Henry McVeigh from your team published the new 60/40 portfolio. So can you shed some light on your view from a overall portfolio construction? If you can own fixed assets, fixed income, public equities, private debt, private equity, just give us your thoughts on a portfolio construction for a family office, an individual who's looking to construct portfolio for the next.
Henry is really the master of the portfolio construction. I'm just a normal private equity practitioner, but I do think private debt is an interesting asset class right now. Number one, for all the reasons that we talked about, with the banks not being there and the returns are actually quite high. With rates being up. These are from an absolute return perspective. I think at this point, it's an interesting asset class to invest in. And so if you're not in it, this will be certainly something that I would allocate some capital to. Cash has gone from yielding negative rates to actually starting to yield some, depending on which currency but some reasonable rates of return. So I think fixed income in one form or another will form a part of people's portfolio, whereas before that was quite difficult, or you had to take significant risk, which were equity-like, in which case you may as well have been into equities. And then for the reason that I mentioned, I do think it's not a bad time to be investing in private equity at this point. So the stock market, while yes, it's adjusted, but it's come back quite a bit. I would be maybe a little bit less enthusiastic and a bit more cautious. And I think those are effectively the views that you've got reflected in Henry's asset allocation.
Okay. I mean, two more questions before we wrap up. We're coming to our time. One is a lot of pressure on banks, mainly U.S. banks, but also we've seen in Switzerland, UBS, Credit Suisse. what's your view on this whole volatility? How are you thinking about it, as in the context of European banks versus US?
Look, I think the European banking system is very stable, and I think we've had actually. I think even if you look at the, I think I saw today or yesterday in the FT an article on the exposure to real estate of the European banks compared to the US banks. It's actually not such a big exposure. I think it's less than 15%. And in the US banks are quite some of these regional banks are actually quite leveraged toward commercial real estate. And so I think that's part of the reason we're seeing some of these risks. But I think Silicon Valley Bank, First Republic, Credit Suisse were rather special cases. And most certainly when you see what the European regulator has done, I think they've been quite conservative, and the banks are actually in much better shape than what they were in 2007 and 2008. So that I don't think that we see any significant consequences there. I do think the commercial real estate exposure will come through, and we're going to see some effects of that. But that's different from the sort of short-term backgrounds. That would be my perspective.
Okay. And last question, maybe a bit more personal. I mean, you've been in the market for more than 30 years, Johannes. What would be a advice you would give to a young graduate who is, coming to this field? What would be your advice, whether they are studying today or whether they're starting their career?
I still think it's a very exciting field, right? We get to invest in businesses, and I always say it's important. People ask me, how do you become successful at KKR? And I say, well, it's important that you feel enthusiastic about what you're doing, that you have a genuine interest in business, and then on that basis make investments. And I do that. That's what I still like doing. That's why I'm still doing it. And I think that sort of curiosity about what works in business is absolutely key. And I don't see another area where you can use that and as exciting a field as in private equity.
Great. Well, thank you, Johannes, for your time. And it was a pleasure talking to you again, and hope to see you in person soon.
Thank you, Naji. It was a great discussion. Really appreciate it. Thanks very much.
Bye-bye now.
Okay, bye-bye.